This is the Regina Vacuum Cleaner Company after Don Sheelan got a hold of it.
Gail Nichols is a former federal prosecutor. She prosecuted Regina President Don Sheelan and other company executives for preparing false financial statements.
It appears that Don Sheelan wanted a successful business and he was willing to get it at any cost. He did it to maintain a successful business.
Don Sheelan invested his life savings into acquiring the controlling interest of the Regina Vacuum Cleaner Company. After that, he had to figure out how to make some money out of his investment.
Regina Vacuum had been in business a long time when Sheelan took over. Sheelan had big plans to increase sales and diversify the product lines. That was a mistake. Sales fell short of his rosy predictions. Rather than tell the shareholders, Sheelan turned to his chief financial officer for some creative accounting techniques.
In effect, what Don Sheelan did was talk his lieutenant, Vince Golden, into cooking Regina's books.
The first time I met Vince Golden, I was particularly struck by what a nice person he was and by the fact that he would have never committed the crime he did had he not felt forced to do it.
Golden employed one of the 8 common techniques for financial statement fraud: premature revenue recognition. There are 4 schemes associated with this technique: holding open the books past the close of the accounting period, bill and hold schemes, conditional sales, and delayed posting of sales returns. Golden also failed to post certain expenses at year-end, thereby increasing net income.
The nuts and bolts did not ever become wholly public, but simply put, it did become public that Donald Sheelan directed Vincent Golden, who in turn directed others, not to record returned goods as they were returned to the factory. In addition, Donald Sheelan told Vincent Golden, who told others, to create false invoices, thereby creating false accounts receivables that went on the books and records as assets. And finally, again, Donald Sheelan told Vincent Golden, who told others, not to report all of the expenses, and thereby they created a scenario where the net earnings per share was higher than in fact it was.
The auditors for Regina might have been a little bit more suspicious if they had realized how much Don Sheelan really had to lose.
At the point that he became the CEO, this business totally changed. It was as if a new business emerged, and the auditors should have recognized that. They should have said, this is no longer the same business that we used to audit. All of a sudden, they went from 1 product to 4 products. They diversified. They changed almost everything they did. And again, you have to look at him and see what motivates that CEO. I mean, if you've read the story, Sheelan had a sister who was extremely successful, and he was somewhat jealous of her success, and he wanted to be successful. And again, his personal worth was tied to the company and the stock price of the company. And so his personal worth, his total life was tied to Regina and making Regina successful. And, you know, we should know that, and we should understand that, and we should understand what motivated this CEO.
The first time I met Don Sheelan, I was struck by the tremendous focus he had on success and on his desire to do well.
One of the ways Sheelan decided to do well was to change up the product lines. He replaced metal parts with plastic because it was cheaper. The only problem was that the new vacuum cleaners weren't any good.
He actually had an advertisement filmed where he was using a carpet sweeper that had a beefed up motor in. And then when they started sending these things out and selling them through stores, they were melting. That was a different motor than was in the one that he had used in the advertisement. And I mean, the returns were just coming back by the crate load because, you know, these things weren't any good. And yet the company didn't recognize those. And the reason that he didn't recognize them is because he was so preoccupied with showing a net income and having that net income impact his stock price.
Because Sheelan was in collusion with several of his key employees, the internal auditors at Regina may not have been able to detect what was going on. Their responsibility to detect fraud is defined by the Institute of Internal Auditors Internal Audit Standard 1210. In part, it requires the internal auditor to assess the internal environment for fraud risks, have sufficient knowledge to recognize fraud indicators or red flags, and recommend appropriate investigation if the circumstances warrant.
The most impressive thing was that Don Sheeland and Vincent Golden, before anyone detected they had done anything wrong, and before they even believed that anyone was going to catch on, they themselves went to their wives, went to their priests, went to their lawyers, and then came to us and confessed. It was simply because they had a guilty conscience and they came forward. It's the most unique thing about this case.
If the internal or external auditor fails to exercise appropriate care in conducting the audit, he or she may be found guilty of negligence. Here again is W. Michael Kramer.
Negligence, as a legal term, is defined as the failure to exercise the level of care that is the norm in the particular industry. And in auditing or accounting, we could establish the level of care that's required by reference to the professional standards. So if auditors fail to design audit steps or fail to pursue obvious indicators of fraud, they may be held liable for negligence or substandard audits.
Regina's financial statements over a 3-year period reflect trends that may have alerted the auditor to possible fraud. Accounts receivable increased from 33% to 43% of total assets. Fixed assets as a percentage of total assets decreased. Inventories grew from 22% to 31%. As a percentage of net sales, cost of goods sold dropped from 61% to 52%. Day sales in inventory went from 76 days to 113 days. Receivable turnover decreased from 5.3 to 3.5. Inventory turnover decreased from 4.8 to 3.2. Net sales increased 110% without a corresponding increase in the cost of sales. There were other clues too. Bill and hold schemes, which were used to falsify sales, were concentrated in just a few customers. Numerous large journal entries were made at year-end. Gail Nichols points out this is common when cooking the books.
I've had experience investigating many cases, and based on my experience, I have an understanding that if accounts receivables, excessive accounts receivables, are all concentrated in just a few accounts, an accountant should become suspicious. And in addition, if the accounts receivables are all created 1 or 2 days before the year end, that should also trigger further investigation.
ESM Group Incorporated of Fort Lauderdale, Florida, was in the business of buying and selling government securities. Like many other businesses, their fraud started when they encountered financial difficulties.
1975 was their beginning. They limped along. They were incorporated with very few dollars. The first statement we were able to locate for them, the firm was then known as Uten, Seneca and Mead, later changed to ESM, showed a deficit in stockholders' equity of $68,000. So you can see it was a very small firm. In 1978, Mr. Seneca booked a transaction with a school board on Long Island for approximately $3 million in government bonds. That trade was decayed or not known or rejected by the school board. So they had to buy in those bonds. Those bonds then had a decline in value. So they were trapped with basically a negative net worth. They were insolvent.
Thomas Tew, a Miami attorney, was hired to sort out ESM after it collapsed. What he and his team discovered was that ESM's principals had used customers' securities, which had been left with them for safekeeping, to cover massive losses caused by poor trading and high living. What started out as a bad business deal ultimately led to losses of over $300 million.
Rather than throwing in the sponge, saying this was a bad business deal, perhaps even litigating the issue of whether that was a proper trade or not, Mr. Seneca and the others decided that they would attempt at that point to hide the loss. That became the long trail that ultimately led to the $315 million. At that point, they began to engineer their financial statement and to concoct what became the fraud of ESM. Their first objective was that they convinced themselves that they could trade out of the problem. They said, look, we've lost this decline in value on the bond trade, but we can make that up because we're shrewd traders. P.S. They went off immediately and lost $70 to $80 million in trading losses. So they weren't such hotshot people as they portrayed themselves to be. That really put them foursquare in the middle of a fraud.
The fraud was masterminded by one of ESM's partners, Alan Novak. He figured out that the losses could be covered up by simply transferring them to a shell corporation. After 7 years of cooking the books, Novak died suddenly of a heart attack. That's when Chairman Ronnie Uten decided to call it quits.
I don't think had the capacity nor the stomach to continue juggling the books. He had, in early '85, resigned as president, called in George Meade and says, it's all yours, I'm leaving, because he had gone and got counsel. I think that's when Mr. Meade realized that he was being left holding the bag. And that's why Mr. Meade contacted his private lawyer, Mr. Cagney, who brought myself in.
Tew brought in Laurie Holtz, a certified fraud examiner and CPA, to look at the financial statements and determine what had happened.
And they handed me a statement and said, tell us what's wrong with this statement. I opened up the statement and I said, oh my gosh, this is some large company. And look at that. It's dated January 30th. It's been given out. And then I looked at it and I saw $3 billion. I read it and I noticed that there was on the asset side a number called securities purchased under agreements to resell for $2,945,953,000. I also noticed that there was, in the liability section, something called securities sold under agreements to repurchase. For those of you who don't know what these long phrases mean, it really means borrowing on the liability side and lending on the asset side. The fact that there are securities involved doesn't mask the fact that it's a receivable against a payable. I looked at this and I said, how could somebody lend exactly the amount they borrow? It didn't make sense.
ESM's business was not only to buy and sell securities, but to borrow and lend money. The transactions are called term repurchases and reverse repurchases, or term repos and reverse repos. In a term repo, customers, usually state and local governments, agree to loan money to ESM secured by government securities. In the reverse repo transaction, the customer, usually a financial institution, borrows money from ESM collateralized by other securities.
Let's say they borrowed $8 million but put up $12 million in securities. Well, the 8 goes out, but you get 12. So you got $4 million to play with. That's free cash. And once they realized that free cash was there, they could run this fraud and keep the doors open and give the appearance to the auditing team that they were successful.
ESM insiders convinced many lenders to let the company hold their collateral. That was a big mistake.
The monies would come in. They would send them a fraudulent letter saying that we have segregated your securities that secures your loan to us at our bank. Well, Wall Street, when they saw these high prices, got in the act too. They would lend money to ESM on the term repo side, but they were sophisticated enough to immediately have their agent bank take possession of the securities. So ESM recognized that as long as the term repo government bodies didn't take possession, they could in fact churn that money and sell those securities over and over. And as long as they had a working relationship with a reverse repo participant who would lend them excess margin, they could use that cash plus the resales and the use of the cash on the term side to cover up their massive trading losses. Now the problem is with a $90 million, $100 million trading loss, the interest carry on that compounds your problem. And they were forced to take more and more market risk to try to dig their way out of the problem. When it finally collapsed, it was approximately $340 million that they had borrowed in excess of what they had lent.
Another common method for committing financial statement fraud is through related party transactions. The two usual schemes involve conflicts of interest and sham transactions. That was the method used to cook ESM's books. How were these massive losses covered up? It was a simple accounting entry. ESM Group was audited while its affiliate, ESM Financial Corporation, was not. So Alan Novak simply transferred the losses to its affiliate as a receivable.
When they had their loss in the first and second year of their business, Novak thought up a scheme that he could take his shortfall and he could make it disappear by a very simple method. If he had borrowed more than he had loaned, by virtue of taking the same named securities and treating them where he had borrowed as if he was selling securities to an affiliated company with an agreement to repurchase, or purchasing securities from an affiliated company with an agreement to resell, he in effect crisscrossed his assets and liabilities so that where the liability was greater than the asset in the ESM government securities, he then created an asset due from an affiliate that was greater than his liability to that affiliate for the exact amount of the shortfall.
That shortfall continued to grow. And as it grew, Ronnie Uten and his gang of thieves threw caution to the wind. They paid themselves millions in salaries and bonuses, and somehow they thought they could make up the shortfall through risky trading. It didn't work. The scheme wasn't difficult to uncover. On the first day of the investigation, Tew and Holtz asked for the books of the parent company and its affiliate, ESM Financial. It was all there.
I asked Laurie where they obtained the records, and he said when they came in, the employees of ESM, upon request, went right to the file drawers in the audit department, accounting department, and pulled the general ledgers right off the shelf. And I said, my goodness, I would think these things would be in the bottom of Biscayne Bay. But there they were, all laid out in the workroom, together with perhaps the most amazing of all, that income tax returns for the companies that showed massive losses of in 1 year up to $90 million in trading losses. And obviously for a company that had no initial capital other than a few $1,000s to start, the question had to be asked, where did these losses come from? And how could you show an increasing retained earnings at December 31, '84 when you laid it down next to the tax return? The tragic thing was that the tax return and the audit had been conducted by the same accounting firm. So we knew we had a major, major problem.
One of the biggest problems was the partner in charge of the audit, Jose Gomez.
Jose started living above his means and ran up about $15,000 in credit card charges. Alan Novak sensed he had a problem. Alan just volunteered to help him, saying, Jose, and we all run into these problems, let me be your friend. At that point, Jose was compromised. But Jose didn't do that in exchange for doctoring the accounts. What happened is that Jose and his team missed the cover-up in the first year. When it became known to him in the second year, Novak confronted him with saying, look, do you really want to go tell your partners that you blew this audit? Do you really want to go out and recall all the statements that you put out that were false?
If Gomez had reported the fraud instead of covering it up, he wouldn't be serving 12 years in federal prison.
Every young accountant and lawyer, all professionals, we are from day one adverse to failure. We are taught day one to get good grades. We're taught day one to do good work. Very hard to reverse that emotional trend and say, I messed up, boss. There's a financial statement out there that's wrong.
The external auditor's responsibility for detecting and reporting illegal acts is found in the AICPA's Statement on Auditing Standards number 54. Among other things, it requires the external auditor to be aware of the kind of illegal acts that may occur, develop appropriate audit procedures to determine the impact on the financials, ensure that material illegal acts are properly disclosed, report the existence of the illegal acts to the audit committee, and in certain instances, disclose the illegal act to outside parties, such as the SEC or the succeeding auditors. If management will not cooperate in the disclosure, the external auditors may need to modify the opinion or withdraw from the engagement. Tom Tew says a fundamental understanding of the securities business would have helped uncover the fraud before it got so large.
Now, another thing that we think that the auditors misunderstood not only was the business, but how could this small firm pay these salaries? And how could these people on the very thin margins of the government securities business, how could they have jet planes, 70-foot yachts, polo ponies, farms, ranches? So you wondered if anyone, the most expensive cars in the world, Aston Martin, Lagondas, Ferraris. The parking lot, when I took over and I asked everyone to turn their cars in, looked like an exotic car lot with all the Mercedes and Jaguars and foreign cars that were turned in by the staff, by the senior officers. So not only did they didn't understand the business from a technical standpoint, they didn't understand the margins that the business gave to a legitimate operating dealer. And therefore, how could they pay all these salaries unless they were taking it from someplace? And they were taking it from customer funds.
Unfamiliarity with the industry seems to be a problem over and over again when we have a fraud. It was certainly the case in ESM, where the auditors didn't understand repo transactions and reverse repo transactions and recognize them for what they are. All they were the net receivables and the net payables. And when those two numbers were the same, somebody should have questioned that, but we didn't do that.
They didn't understand the business. They did not understand, and I think that's typical of so many accounting problems and major malpractice cases. The young people working on this case in Fort Lauderdale were no match for the wit and guile of Alan Novick, who had been a white whale partner on Main Street, on Wall Street, and knew the industry backwards and forwards. Jargon was accepted by the accountants. They didn't understand transactions. They didn't, in my opinion, have the proper training before they took on this engagement. This engagement became a very important economic matter to the Fort Lauderdale office of this accounting firm. In fact, it became the dominant source of business for this office. Couple that with a young partner, one of the youngest partners in the system, who was extended beyond his means and an easy target for Alan Novick to corrupt, and you have the makings for a massive accounting fraud.
Failure to design audit programs to detect fraud can have serious consequences. Here again is Tom Tew.
One of the first cases we filed, and the largest part of our recovery, was against ESM's auditing firm. I sued them for professional malpractice or negligence and breach of contract. Many of the people who hear about the ESM case think that the auditors were sued for fraud. They were not. They were sued for negligence. And a trial was held in which we obtained the largest malpractice trial verdict in the country of $70-odd million.
An auditor's responsibility to detect fraud can be summarized essentially as designing audit steps which provide a reasonable assurance that significant or material fraud will be detected. And then if fraud is detected, to extend the audit steps to the necessary extent to try to resolve it.
A detailed analysis of ESM's financials over a 4-year period reflects potential problems. When compared to total assets, securities purchased under agreements to resell grew. Receivables and payables for securities transactions were exactly the same in 3 of the 4 years. This is unlikely in any year, not to mention 3 out of 4. From 1981 to 1982, total assets decreased by 38%. In the next year, they increased by 183%. In the last year, they grew another 14%. Although assets and income increased, the percentage of cash actually decreased. And finally, the footnote to the financials reflect a very large receivable and payable with the SM's affiliate. Although they were disclosed, these transactions were obviously not well understood.
You know, I think, unfortunately, that the only thing that's going to work is for major verdicts to hit the accounting profession, where they realize that they can't send teams of young, untrained people in to do intellectual battle with very sophisticated businessmen.
The responsibilities of the certified fraud examiner are different from the auditor. Although many CFEs have an accounting background, the focus of the work is fundamentally different. The CFE is responsible for resolving allegations of fraud, obtaining evidence, taking statements and writing reports, testifying to findings, and assisting in the prevention and detection of fraud. Here again is W. Michael Kramer.
A certified fraud examiner is expected to have the skills such that he or she could take a fraud case from inception, from the initial indicators of fraud, to conclusion or resolution, either by the filing of a claim, a fidelity bond claim, or a civil claim for damages, or referral for criminal prosecution. Fraud examiners are a hybrid of auditors, investigators, and even lawyers, in the sense that a CFE is trained in the areas of auditing, investigation, and law, as well as criminology. It is a discipline which builds on audit skills, but is quite a bit different than what an auditor is expected to do.
Barry Minko has a different idea for the use of the certified fraud examiner.
My question would have to be, has there been enough dollar amounts in money lost between ZBest and between people like Boesky and the savings and loan industry to justify another entity, whether it would be auditors or not, to detect fraud? I think so. Here we're going to say it up front. Yeah, I'm the auditor, and yeah, I want your business, but you know what? It's more important to me that you're not a fraud. And since you're not, and I know you're not, you can sell that back to the client. You have to have our fraud investigation people. They're completely separate from me. They don't talk to me. They're here to look for fraud, and that's it. They'll do 2 weeks. They'll go through the whole books. You got to give them access to everything. Man, would that stop a lot of frauds or what?
I think the accountants are in a very peculiar situation. First of all, just like lawyers, they're in there for business, so they're getting paid by the people they're looking at. And it's a very difficult situation because they have to be nice to their client and at the same time investigate their client. And it's almost a conflict from the beginning. Do I think they're detecting fraud? No, I think they're trying not to detect it. They're in there believing that their client is honest because they have to, it's their client. And instead, they just want to make sure that the client is treating the money going in and out properly. So I don't think they're looking for fraud. I think they're just trying to verify that the books and records are accurately compiled.
An auditor cannot be on Thursday a manufacturing expert, on Friday an inventory expert for a chemical company, on Tuesday a retail expert, and then the next day a service business expert. You see, the accountants have to learn one thing. They have to know their weaknesses, and they don't.
I think the profession has to go back to the standards that made it grow in the first place, and the care that made people use accountants, the care and professionalism that made the profession grow in the first place. They should reward care. They shouldn't reward sales. They should be teaching the people in the field that they want to do good work more than they want to have customers happy. Keeping customers happy comes from giving good work. It doesn't come from closing your eyes. It doesn't come from trying to make the picture pretty because you think that's what the client wants. If there's a client and your nose tells you something doesn't feel right, then go at it. Don't quit until you're absolutely sure.
Well, I think what every accountant ought to realize constantly is that we're creatures of human nature. and businessmen put under serious financial pressures, some of them, not all of them, will bend their ethical standards that perhaps they started that business with. And that's what the auditor has to be concerned about. The auditor has to be concerned about human nature. He has to understand the business that he's auditing, because he has to know the business and the tricks and the games that every business has indigenous to it.
The SEC holds us responsible. The public holds us responsible. Whenever there's an audit failure or there's a fraud or even a bankruptcy, a lawsuit is almost predictable. I mean, it's automatic. And we're being held accountable for those. We either are held accountable because we lose in court or we spend a lot of money fighting those suits. And maybe it's time that we as a profession just raised our hands and said, okay, you've pushed us far enough. We accept the responsibility to detect fraud, and we're